My name is Winnie Ogejo, and I work at the Institute of Economic Affairs. And for those who are joining us for the first time, the Institute of Economic Affairs is a public policy think tank. We are based in Nairobi, Kenya. And what we do is we conduct research and use our research findings for policy dialogues and discourses. So this morning, we are having yet another interesting conversation that has been a conversation that Kenyans have had for quite a while now. So what we are doing, we are giving it a different twist, as I will be explaining as we proceed. So today, our conversation is on Kenya's debt exit and what it would take for Kenya to be debt-free. And for perspective, when we're speaking about debt-free, we are not saying our debt is at zero. What we are saying is, what can we do to approach that debt-free status? And the debt-free status entails having a sustainable debt, a debt that we can actually manage as a country and we're not straining to pay it. And of course, with that, we progress towards a debt-free country by 2040. So as we all know that Kenya's debt has grown significantly over the past 2 decades. And as current as today, our total debt stock stands at just over 11.5 trillion. That's big. So what we are saying is, while public borrowing can play a critical role in financing for development, especially for infrastructure and social programs, there is no legal obligation for countries to borrow for its development budget, but countries find themselves borrowing. And once we have borrowed, of course, there's a debt burden that is passed to its citizens. So we are also aware that when a country has high debt levels, there are macroeconomic risks, and these risks include rising debt servicing costs, reduced fiscal space, and potential crowding out of private sector investors. So our forum today, we are just asking a very bold question. What would it take for Kenya to achieve a full debt exit by 2040? And before we even get there, is it possible? How can we transition from this persistent fiscal deficit and reliance on debt to a path of long-term fiscal sustainability and economic self-reliance, where we are having a balanced budget? Our revenues are matching our expenditures. And the big question we are asking ourselves as we are thinking about the debt exit, are we rethinking the country's structure of revenue systems? Are we evaluating the quality and efficiency of our public expenditure? And are we questioning the role of debt management strategies? So our conversation today is not merely theoretical. We are thinking about it in terms of it being a strategic economic goal that repositions Kenya in the in the global financial systems. And that means we are enhancing our credit worthiness, and we allow the future generations to enjoy the benefits of growth without having the burden of excessive debt repayment. And because I've mentioned a debt is a burden to the future generations. So in our today's discussion, we hope to explore what reforms are necessary to get us there, the trade-offs that we need to make, and the innovations that are required to make this vision a reality. And to have this conversation with us today, we are privileged to have three speakers. We have Rama Nyang, who is a business journalist. We have Johnson Derry, who is a finance and economic analyst, and we have Stella Swakei, who is an economic investment analyst. So before we proceed, I'll just give you a few housekeeping rules. You are all on mute, your cameras are off until the plenary session, where you will have an opportunity to unmute yourself or to type in your question to the speakers. But as the conversation is ongoing, if you have a question that you feel is you want to type in, please feel free to use the chat box, type in your question, and during the plenary session, we will be very glad to have a conversation and respond to your questions. So an outline of our conversation today is I will take us through the Kenya's debt status, and then we will then proceed to the big question where we will have our speakers give us their perspective on the road and the path towards a debt-free Kenya and what it would actually take. So as we proceed, the slide on your screen unpacks to us Kenya's picture of now when it comes to debt. So we are clearly seeing the table shows us our sources of debt, the debt in Kenya shillings, and then the debt in USD. So from the table, you see that Kenya has three categories. Kenya's debt is categorized into three. So we have the domestic debt, the external debt, and the other debts, which we will be explaining. So when we are looking at the domestic debt, we have the treasury bills, and we know that treasury bills are short-term loans and are more liquid. And then the treasury bonds are the biggest part of Kenya's domestic debt, making up 43.73% of the total debt stock. And then we have the pre-1997 government debt at 0.16 debt, so which is a very small portion. But so you realize that Kenya's debt stock is after 1997 coming up to 2025. And then when we look at the external debt, you see the IDAs, the ADF loans, bilateral loans, multilateral loans, commercial loans, and the international sovereign loans. And we all know that the IDA loans, for example, are just concessional loans, and the interest rates are very high. And most of the times they are a part of development loans, and they tend to be long-term. Then when we come to the other loans, this is where we have pending bills and publicly guaranteed. And the other loans are a mix of both external debts and domestic debts. So this data is up until June 2024. So our total debt as at June 2024 was at 10.58 trillion, with the domestic loan taking 51.13% of the total debt, and the external loans taking 48.87% of the total loan. So this was just to give you an idea of what constitutes the total debt of Kenya. So let's proceed to our next slide. And in our next slide, we have already taken you through Kenya's debt stock up until June 2024. Now we want to make a comparison to the present day. But because of data sources are incomplete and the data that is complete is up until April 2025, we are making a comparison of year ending June 2024 up until April 2025, a 10-month period. And what we are seeing is at the end of June 2024, the domestic debt was at 5.41 trillion. And as April 2025, the debt had grown to 6.16 trillion. The growth is of about 753.82 billion. So let's unpack this domestic debt. What we are saying is we are accumulating debt at an equivalent of 75 billion per month. And if we break it further, it sums up to about 2.5 billion a day. And if you further break it to what is accumulated for each Kenyan, it means that for the domestic debt, each Kenyan accumulates 50 shillings per day on debt for the domestic side. Let's now look at the external debt. And as at June 2024, the debt was at 5.17 trillion. And April 2025, a period of 10 months, it had grown to 5.32 trillion. The growth change is about 156.18 billion. If we unpack it just like we did for the domestic side, we notice that the change is of about 15 billion a month. Unpacking it to a day, we are accumulating about 0.5 billion per day, meaning each person, each Kenyan, the 50 million of us, are accumulating 10 shillings per day in debt. That is for the external side. If you combine the external side and the domestic side, each Kenyan is accumulating 60 shillings in debt per day. And so if we look at this change, the accumulated change in debt, we are at 2024 June, we were at 10.58 trillion, and we have grown to about 11.5 trillion. The change is about 910. But if all things constant, if the variables don't change and we maintain that growth, then it means that over a period of 1 year, we would have accumulated 1.2 trillion in additional debt, a period of 1 year. That is very huge. And if you look at the 1.2 trillion, the interest rate on debt is about 1 trillion. So we have actually accumulated over and above what we were supposed to pay in interest. So this means we end up finding ourselves in a situation where we are borrowing to repay these debts. So this is just to give us a snippet of what our growth looks like and what we are accumulating. And of course, that accumulation still means we are still going further into debt. And if you look at the growth as a share of GDP, as of 2024 June, we were at 65.7% of the GDP as a share of GDP, and that has since grown. As of April 2025, it has grown to 66.9%. The percentage change there is 1.2%. So that should actually prick our mind and ask ourselves, when you're speaking about our debt growing, this is the actual picture. And if we were to look at the data at present in July, of course, we will see some differences, but you're working with April 2025 because that was the complete data set we could get from the National Treasury. Let's now come to a conversation now that we have brought you to understand where our first point was to show you our distribution of debt. Now, the second part, we showed you the government, how our debt is performing. And now we want to show you the government's borrowing patterns. So the table you're seeing on your screens compares Kenya's actual borrowing from external and domestic sources to what it had actually planned to borrow in its medium-term debt strategy for the fiscal years 2019-20 up until 2023-24. And you can actually see that Kenya consistently borrowed less from external sources than it had planned in all the years. The largest deviation was in 2023-24. So what we were showing out of this is what Kenya intended to borrow against what it actually borrowed. And what we noticed is that Kenya's actual borrowing from the external and the domestic sides, both sources, exceeded what was actually supposed to be borrowed. So for instance, in the financial year 2023-2024, under external borrowing, Kenya intended to borrow 50%. What was actually borrowed was 27%. The deviation there is about 23%. And when you look on the side for the domestic side, Kenya intended to borrow 50% again. So there was supposed to be a balance between the external borrowing and the domestic borrowing. But the actual amount that was borrowed was 73%. The deviation there was 23%. So we borrowed over by 23%. So you notice that there's a shift towards domestic borrowing, and Kenya has consistently relied on domestic borrowing more than the MTDS had planned. And in 2023-2024, the government borrowed much less externally and much more domestically than it intended. The implication for this is, for the domestic borrowing, we know that these loans are more expensive and mostly short-term, and this means the interests are actually higher. So the borrowing interest rates are higher. And then with this, we also are at a risk of underperformance in the external. And this can be reflected. You notice there is the implication for this. The reason for this could be limited access to international credit and also unfavorable global conditions. So we end up having an over-reliance on domestic markets, and this crowds out private sector creditors and who actually and there's also an inflated interest rate for the domestic. So this simply means that the deviation from the intended MTDS actuals to what was actually borrowed undermines the fiscal discipline. And then the long-term stability plans for the loans are clearly not adhered to. So there's fiscal indiscipline happening somewhere. So now that we've taken you through that, let us look at Kenya's maturity profile. And you notice that we have shown you that interest rates are going up. The implication for that is interest rates are going up. We have crowding out on the private sector as implications. So let us look at our maturity profiles. So you notice that a higher number of the loans from the table on your side are to be paid sooner. The share of loans that should be paid sooner is also growing, meaning as much as we want the quantum of loan, as much as the quantum of loan is growing, it comes with payment, with a repayment pressure. So let's look at that table. And we notice that for the end of June 2024, about 78% of domestic debt matured in less than 10 years. So we have medium term, we have short term, medium term, and long term. The short term is less than between 1 to 3 years. The medium term is between 4 years to 10 years, and the long term is above 11 years. And if you look at that table, you notice that as at the end of June 2024, about 78% of the domestic debt matured in less than 10 years. And at the end of June 2023, it was at about 73%. So there's an increase in the short-term loans from 16.7% as a share of the total domestic loan to 18.6% as a share of the total domestic loans. And we notice an increase in the short term that should be repaid in less than a year. What this means is the government is finding itself in a position of thinking about refinancing for the short-term loans or having a rollover. And when you're having a rollover, you find yourself in a consistent cycle of debt where you have to borrow to repay. So for the medium term loans, which is between 4 to 10 years, you notice that the debt has expanded significantly. Well, this is probably a good sign towards reducing the short-term debt pressure. For the long-term debt, which are 11 years and above, that has also slightly reduced, limiting future sustainability buffers, where now we have to start, the country has to start rethinking of financial cushioning and provision and having provisions that would help the government manage its debt repayment obligations. And you can also tell that what we were speaking about when we are speaking of the 700 billion growth, this is where you actually see it, because there's a growth from 33.745 million USD to 40.47 thereabout, which is equivalent to the 700 that we had initially talked about. Now, We have looked at Kenya's debt sustainability. We want to now unpack it for you in terms of present value of debt. And when you're speaking about present value of debt, what we mean is you take all the public debt owed in the future and bring it to the present value. And if you look at the table on your screen, in 2024, the projection by the National Treasury of debt to GDP in present value is 63%. But let me take you back to a chart that we had looked at. And you notice that in 2024, at the end of 2024, a debt as a share of GDP was actually 65.7, meaning that projection was actually missed. Because here they are saying 63, we've actually hit 65 or 66 thereabout. So and what I didn't mention at the beginning of this table you're seeing is the benchmark. The benchmark threshold for the present value is 55, and this is a legal provision in the Public Finance Management Amendment Act of 2023. So the projection shows a downward trajectory for the present value to debt to GDP. But we are worried that given that they already missed that projection, they might not catch up and recover. But even if they do, for them to get to the benchmark of 55, it will take them up until after 2029 for them to get to this benchmark. But remember, what the conversation we are having is how to get to a sustainable debt. They have already missed that first projection. How sure are we that we will actually have these other projections met? And for them to even half it from what is present, which is about 67 from this previous slide, from the 66.9. In 2025, you see their projection is 35, which is almost half. They would by 2044, they're just projecting that they will have halved it. Is it possible? Seeing that they already missed this other projection? Those are the questions we are asking. So when you look at debt servicing to revenue, you notice that in 2023, 2024, the debt service to revenue was 60.6. This means that for every 100 shillings collected in revenue, 60.6 shillings was going towards debt repayment. That is significantly high. They project that it would go higher in 2024 to 63.7. We worry that this projection could actually actualize, having missed the other projection that they had. So the big question we are asking ourselves, that we understand the effects of debt and what it is doing to our economy. We have already laid out the picture of what Kenya's debt stock and what debt borrowing looks like. We now want to go to our panel and have the conversation and ask ourselves, knowing what our debt stock looks like, what do we need to do? What are the good, bad, and ugly conversations we need to have for us to get ourselves to a position where we are saying we are walking the path towards debt sustainability and further towards being debt-free? So like I mentioned, we have 3 panelists who will speak to us and give us their perspective of envisioning a debt-free Kenya and what that would look like, what that journey would look like. For us, we believe it would be a very difficult journey, but is it worth having? Is it worth us going through the difficulty? So our panelists will take us through that, and I will be beginning with Stella Sekei, who will give us her perspective of Kenya's journey towards debt sustainability and whether or not she thinks it's something that we can achieve as a country. So Stella, kindly, you could proceed to give us your views on Kenya's journey towards being debt-free in 2040. Karibu.
Thank you for the opportunity to speak in this particular forum. So I have just a few slides to illustrate my perspective or viewpoint of whether it's possible to have a country that is debt-free by 2040, and you realize that is less than 2 decades. So we have like 15 or so years to get there. So my key highlights on this particular topic or phenomenon are 3. And number 1 of it is that eliminating national debt by 2040 is quite an ambitious target. And this significantly defies the current fiscal dynamics that we have in our country. Because remember that whatever we do, it will definitely and significantly require the goodwill of the governing regime that we have, the government of the day. Number 2, and you alluded to this, Winnie, is that debt is not entirely bad. It can serve as a catalyst for economic growth rather than a constraint to the economic development of a particular country. Number 3 of my key highlights is that while the issue of eliminating debt or having sustainable debt levels in our country is the main point at this particular at the current moment, we have other persistent issues that are quite pressing for us as a country. So just to elaborate on what I meant with my key highlights, I have a slide here which shows how things would look if we were to have minimal levels of debt by 2040. So looking at the numbers and what we have currently, if we need to have low levels of debt by 2040, then it would mean we be paying an amount of around 62.25 billion monthly. And this again could mean that we are using an average, because then we have interest payments that we pay, and this is roughly 10% per annum. So looking at those numbers and comparing an annual figure, we would then be required to pay 108.3 billion monthly in debt servicing. So this will include the principal as well as the interest payments. And then remember that we collect around, at the current moment, around 2.5 trillion in revenues, including appropriations in aid. So I am looking at 208 monthly revenue collections, that is in billions, and then a monthly expenditure that would result from this would be 108 billion, considering these particular numbers that we are talking about. So what we are looking at, if we are to have very low debt levels by 2040, then it means we will have to slash our expenditure by more than half. And this is recurrent expenditure, development expenditure, and what is disbursed to counties. So when you look at that, then it means we are looking at cutting our salaries, which again means it's either the current force that we have accepts to have 50% of their salaries slashed, or we slash the number of employees that we have in our various ministries and departments. So that said, we need to put it correctly that the road might be too difficult, but are we willing really to take up that particular road? So we are looking at hospitals, we are looking at the Ministry of Education, we are looking at TSC, which or the Ministry of Education, which gobbles up almost 28% of our expenditure in terms of, or excluding the money that we pay in terms of debt servicing. So for me, in that perspective, I think if we have to get to where we want to be in 2040 in terms of debt, then it means we will have to significantly cut our expenditure from the current levels that we have in the meantime. And this is also assuming that we collect revenues at the current level. We stagnate at that level for the 15 years that we are looking at. On the second highlight that I had in terms of whether public debt is inherently bad, the conclusion is that revenues that we collect may not be able to sustain the completion of capital-intensive infrastructure that we adopt or we want to have once in a while. So for me, this is what necessitates debt, but at the same time, there are key concerns that come with these particular issues. I would also like to highlight that when we have modern and efficient infrastructure in our country, this is usually a key enabler of attracting foreign investments, and this trickles down to a lot of things, including the forex reserves that we hold as a country. So entirely shying away from debt could translate into underdevelopment, and this maybe is not something that we are looking at, because remember the period we had so much jitters in terms of whether we would default as a country, and that is in 2024 before we paid our Eurobond. Remember, we had a lot of capital outflows from our country, and there was so much trickle down effect in terms of the currency, interest rate, inflation, and all of that. So one thing could lead to a lot of issues in the economy. And remember, the economy does not entirely, or it doesn't operate in a vacuum. So at the end of the day, if we have bad macroeconomic indicators, then it means even the revenues that we collect will not be sufficient to fund the budget that we have as a country. And on the third highlight, which was on the concerns that persist in our country, one of them that I note is overpriced infrastructure projects, and this has been a very significant challenge in our country. As much as we borrow money for infrastructure, there's an issue of overpricing, which largely tends to come from corruption. So this is something that leads to final costs ballooning far beyond what was originally projected by the relevant bodies, and it ends up costing the country even more than we would have imagined. Number two is low return investments, and this is where you see the value for money assessments end up with us having projects or wrong projects being executed. And what I mean by this is, when you're looking at funding projects, infrastructure projects, you may want to fund a project that will have more value for the country as opposed to one that will benefit a few people. So I'm not talking about PPPs or anything. I'm talking about the projects that are funded by the government. And I don't know whether I was on low return investments, where we have projects that do not have the intended value for the money that has been used on them. And I was talking of an example where you would be in between considering whether to construct a hospital, whether to construct a school, or whether to construct a road, but you end up constructing, for example, a road that has less value for money in terms of benefiting the populace and the nation, as opposed to a school or a hospital. And then the other key concern is the lack of accountability and transparency. So this again ties with the first point that I mentioned on overpriced infrastructure projects, where we have many loans that are unaccounted for, or they are not entirely linked to specific projects or infrastructure, which then end up being used blanketly as funding the budget deficit. So I will give a good example of the Eurobond that we just cleared in 2024, the largest that we had of $2 billion US. That particular bond, which was also audited, did not have a specific, you couldn't pinpoint where the money went, because the money was mixed up with whatever we had in our coffers, and there was no particular project that was linked to the money. So that went like that, and we paid for it, having nothing to show for it in particular, but blanketly saying that the money was used to fund our budget deficit. Then the final point on the key concerns is over-reliance on high-cost debt. And this one, again, you mentioned, Winnie, in your presentation on where we stand currently as a country in terms of debt. So switching or relying more on the domestic market has its disadvantages and advantages. The advantage is that we kill more of the currency risks, But at the end of the day, we spend more because interest is one of the largest, accounts for the largest part of expenditure that we have in the current years or in the recent fiscal years. So looking at that, then it becomes a problem to overly rely on what we have domestically, not unless we work towards having low interest rate environment, although this is something that also connects with what the economy is like and many other external factors as well as internal factors. And finally, for the question of the day, what it takes for us to be debt-free by 2040. It is a difficult journey, and again, I will repeat that it will require the goodwill of the present regime or of the governing regime. So number one of my proposals or recommendations would be addressing political pressures on spending, because when you look at issues and projects that we have been having, you get to see that mostly these are the promises that are made by political bodies or political individuals. And number two, we tend to govern by popularity. So if one individual is popular than the other, we tend to go or lean more towards that particular direction. So if we have a coordinated method or approach between the agent, that is the fiscal agent, and the monetary agent, minus the political pressures, I think this kind of coherence would lead us to a debt-free or a debt-sustainable country. Because number one, maybe the National Treasury would want to have our debt levels or our borrowing needs lower, and the CBK, on the other hand, may need to have lower interest rate environment. So when we have a coordination or a coherence between these two, then it will be possible to achieve a low interest environment and also be able to have lower targets of borrowing, hence end up with a bit of sustainable debt levels as we move on into 2040. The next thing that I would recommend is shifting the focus to stimulating economic growth. Remember, as I mentioned, the economy does not operate in a vacuum. So the more we subdue the economic environment, the less we collect in terms of revenues. Remember, in the current environment where we say the taxes are punitive, which is a bit relative, but when you look at disposable income, which is something that you can actually see, disposable income has been reducing over time because of the statutory deductions that we get and also the taxes that come in. So this means again that there's no capital for expansion for our businesses and for those that do personal businesses or self-employment, and even money for usage becomes less and less. So the economy becomes subdued and we get to see very many other trickle-down effects, such as non-performing loans, which have become an issue for our country at the moment. The next thing would be lowering the cost of borrowing, and I would tie this with my first point of addressing political pressure on spending, because a lower interest rate environment then would mean the government is paying less in terms of interest. So also, remember when I started, I mentioned that there are advantages and disadvantages of domestic debt. So likewise, the advantages of external debt and mostly conventional loans is that they are usually lower in terms of the cost of borrowing. So if we could emphasize more on that and less on borrowing domestically where the rates are very high, then it would be more beneficial for us as a country. But then I would commend the situation we have currently where interest rates continue to go down and the government is more of or sort of borrowing more of long-term or reopening long-term bonds as opposed to opening new bonds as what we had last year. But anyways, the environment last year was a bit different. So it is a good thing that interest rates are going down in the current moment, but if we could have single-digit interest rates as time goes by, that would be a very important move towards having a debt-free or a sustainable debt environment in our country. So this would also be helped or enhanced by having a stable macro environment in terms of fundamentals, because remember, interest rates always go high when we have higher inflation. And this is also caused by something else, including taxes and also imported inflation. So if we could have and focus on having a stable macroeconomic environment, then this would be a better step in going towards a sustainable debt environment. Fourth, and this is my second last point, is ensuring accountability and value for money. So this is directly linking projects with the money that we borrow. So remember, I gave an example of the 2024 Eurobond, which was not linked to any project, and many other loans that we take. We just say we are doing, or we are filling the gap of fiscal deficit, but we do not entirely link the money that we borrow to projects. And even when you look at the infrastructure bonds that we borrow domestically, it kind of seems just like a name and not linked to any particular project. So in the eyes of the common mwananchi, when you say you're borrowing an infrastructure bond, but we never see this infrastructure, then it looks like money just disappears to nowhere. So having accountability in terms of where we are putting our money and also assessing the value for money would be a very important step in going towards debt sustainability. And finally, I would recommend scaling up public-private partnerships, that is PPPs. And this would be to leverage private sector capital and efficiency in developing capital-intensive infrastructure. So this would remove the burden, not entirely from the government, but it would ease or relieve the burden of the exchequer and of the taxpayer. But then the challenge again persists in terms of ensuring that these projects have value for the country in terms of opening up the economy for more business, for economic stimulation in general. So basically, those would be my recommendations, but at the end of the day, I will insist that this will require the goodwill of the governing regime, and also would take a lot of difficulties in terms of accepting expenditure cuts and also the ceiling of leakages and spillages in our budget, because they are many, a lot of them. Thank you very much, Winnie, and back to you.
Thank you so much, Stella, for your remarks and for just giving us your views on what the Kenyan government should actually do to drive Kenya towards a debt-free or a debt-sustainable status. So, and it's interesting you mentioned the questions of value for money, and the IEA, my colleagues have written and held webinars on the white elephant. So it would be interesting for you to take a minute or two to just listen so that you understand when Stella is speaking about value for money, how deep does it go and how deep does it drive our debt status? So that said, we will now go to Johnson. Johnson, you have 15 minutes to give us your views on whether or not Kenya can actually get to a debt-free state and how sustainable that would be. And if it is, then what should we do to get ourselves there? So Johnson, karibu.
The debt growth trajectory has been incredible. I first noticed it when, I guess I was looking out for it because I was wondering to myself whether the economic growth, economic policies of Jubilee, I wanted to figure out to see how that would play out. And largely, as I suspected, there was always going to be strain on our public resources, or at least government fiscal position. So I've sent Winnie, so kindly look out for it. The growth has been incredible, and if you look at the trajectory now, sort of slowed down a bit, and part of what was driving. Okay, so we can look at it from between 1999 and 2007, where it was largely stable, and then it began to take off in about 2007 to about 2011, where we have a bit steeper, growth rate, and then between 2011 and 2023, or around March 2023, the growth rate was quite steep, and towards the end of that phase, you could say it was accelerated by. You could say the growth rate was being accelerated by fears of default, and you could see it in almost all indicators. T-bill rates. Most lenders or investors wanted to put money in the short-term instruments. Interest rates had gone up to 17, and we're talking about the T-bill here. You can imagine what that meant for everybody else. Up until 2007, you can see the growth rate was moderate, and then something changed between in 08 to 2014, where it was slightly aggressive. But now from 2014 to 2023, where you could say the first peak is the growth rate is incredible, and I guess this is when Jubilee had started its infrastructure heavy economic growth policy, which focused on borrowing to build infrastructure, and we had SGR, we had LAPSSET, and under LAPSSET you had got the ports in Lamu, you had the roads from Isiolo to Mandera, then to Ethiopia. In Isiolo, so that was quite interesting. But then you could say that some of that was exaggerated because of fears of default. Thank God we did not default then. At least the default was expected default was on the Euro bond, which we you could say foreign capital markets opened up just in time for us to refinance, and that sort of cooled down temperatures. But like I was saying earlier, around that time you had an exchange rate collapse. You had interest rates jumping to 17%, and then when that didn't happen, there was a cooling off, and the value of the bonds was since came down. But as you can see, the upward trajectory at some point resumed, and now we have exceeded the peak of March 2024. I think that's when the peak was. Yeah, so this chart is quite instructive. So the question then is, are our revenues growing fast enough to offset this? So I did a bit of little analytics, just to look at tax revenues. Rama, did you take over?
No, not yet. Not yet.
All right. We need. Can you click sheet 1, please? So if you look at that, our tax revenues as at for the fiscal year up until 30th June 2020 was 1.4 trillion, close to double. But if you look at our debt service, has tripled from that point on. Almost tripled. No, it's actually doubled, just around the same time. So you can see the proportion of our tax revenues that have gone to debt servicing. So at 48% for the fiscal year to 30th June 2020, and then debt service for the fiscal year to 30th June 2025 at 69%, peaked last year, and we know why it peaked. High interest rates, collapse of exchange rates. So that has since corrected, but we are still on an upward trajectory. And one begins to see why there is pressure for the Ruto government to raise tax revenue, because they have adopted revenue-driven consolidation policy, which just means that they'll not do much to slow down spending. They're looking at generating more revenues to boost. To achieve debt sustainability. The problem with that is that it's having because it's a rates you are tweaking now, and you're putting additional rates, and as Stella identified, you're doing that. The effect of doing that is lowering disposable income. Then what you're doing is you're diverting more of the country's resources to consumption and away from investment, and away from investment. And investment is how you get your growth. So the economy, struggling along, trying to figure out how to move around this. And so far it has been successful, but we don't know for how long. Because sooner or later, when investment is being impacted, it will come down to growth. Because how do you achieve growth? You achieve growth by investing. And I'm not talking about investing in infrastructure. I'm talking about investing in factories and generating the employment necessary to support the growing population. So what we've been seeing since 2024 June or July was a tax revolt. So the first one was a tax revolt. The revolt was so efficacious. It forced the president to roll back his tax plans. Ultimately, he did pass some of what he rolled back in November, December, and which probably explains the increase in tax revenues. But as you can see, the increase in tax revenues is not so strong. So this government is faced with a couple of constraints. Number one, one could say it has hit constraints on raising tax rates. So that will limit revenue growth rates. It has also a few constraints on paying via inflation. Cost of living is a big problem in the country, what people tend to forget is cost of living and cost of doing business are just two sides of the same coin. So if cost of living is too high, then cost of doing business is also too high. So those are real constraints that government faces, and the constraint manifests itself in social unrest, social and civil unrest. So in my view, if we want to see sustainable sustainable budgets and sustainable debt positions, then we must abandon this revenue-driven consolidation, because I think the experiment has run its course, and we must go we must look at the spending side. Now, back to that chart, as you can see, spending is now being driven by debt service. And one can understand now why government is always late in paying, giving money to county governments. It doesn't fully pay all the, I mean, it keeps buying itself time on pending bills, arguing that it is assessing for fraud, when in real sense it's buying time. And we've also seen some strategic defaults. There were stories of the Auditor General shining light that on facts like Kenya Railways has defaulted on some debt, or this or that or the other parastatal has defaulted on some debt. Those for me are strategic defaults designed to buy the government a bit of time. So I think that will continue. I expect that to continue with debt service being that high. But areas where I think have not been properly addressed arise from number one, the role of government. I think the government is trying to do too much. That's how it got its problem, got itself in this mess. We've got a government with a thinking of remember the KANU thinking of serikali ni baba na mama, where government believes that it is its duty to sort everybody out. But government is just made of men like us, and all it's doing is redistributing. It's not even feeding us; it's redistributing wealth. And for this to work, everybody must get as much people as possible must be involved in production. So we need to start looking at employment rates, because that's the one statistic that is not published, that will tell us about the success of government policy. And we know there's a problem because the Gen Z is one of their key complaints is employment. So that's one area where the government is failing and needs to look at. But how does it address employment? Again, it's all linked to government policy. I think one of the causes for unusually high unemployment in Kenya is the tax rates. The tax rates just make investment unviable, and when those become unviable, then unemployment follows, because without investment, there's unemployment is lower. The other aspect I think the government needs to consider, and I think they have, is trying to raise tax revenues via privatizations, and that's an imperative now. And there are many assets, good assets, that are underutilized that I believe the government could get good revenues from. Kenya Pipeline was one, Kenya Airports Authority is the other, and Ports Corporation is the other. And some of them are existing listed companies like KenGen, the government can reduce its shareholding there. Safaricom, government can reduce its shareholding there. So all those are opportunities to lower the debt burden today, and give the private sector room to to grow. There are some other policies that tend to hinder growth. For example, the idea that the government wants to protect Kenya Airways by limiting the other aircraft, the other airlines' access to our airports, means also that Kenya Airports Authority gets less revenues than it needs to, or than it could. So this protectionist policy is hurting the revenues of one major asset, is the airports. So the protectionism must end. That way, you'll have lower input costs, lower costs of living. And I'm not talking about just Kenya Airports. I'm talking about generally. But the Kenya Airports Authority versus KQ is a good policy to us. I mean, example to assess this policy because all these businesses are interrelated, and I think everybody should be competitive. So Kenya Airways or Kenya Airport authorities should not see its revenues limited because of trying to protect KQ. I think generally all airlines should be should have access to our airports, which would mean more flights, and not just to Europe, also to Africa. I think Rwanda, for example, should have access to Mombasa, Eldoret, Isiolo, when that airport comes online. So really, to sum it up, the reason we find ourselves where we are is because government is trying to do things it shouldn't be doing. And the way out, and I think getting to sustainable debt service, sustainable fiscal position by 2040 is very, very possible, but it just requires government to change its attitude towards its role in the economy. I want to leave it there.
Right. Thank you so much, Johnson, for giving us your views and your perspective as far as Kenya's debt status is concerned and what needs to be done and to get us to a debt-free status. And it's interesting you mentioned about redistribution of resources. And the big question, using an example, is you find with the ongoing conversation on education capitation, you find it's being stifled, and on the side of the housing, the agenda is really being pushed. So you wonder at what point does prioritization happen when they're redistributing? Should we prioritize housing or should we prioritize education? And then when you speak about the protectionist policies that we have clearly seen happening and have been quite a bit of drivers when it comes to our debt quantum growth, you also, if you have an opportunity to read our scenarios, we actually speak to the impact of what having regressive and protectionist policies would actually have, especially when institutions are performing and then the policies are actually stifling. And the debt question is actually a policy question. So it's actually good that you actually bring out that aspect. So we will move to Rama. And Rama, you also have 15 minutes to give us your idea, your perspective on Kenya's debt status, what we need to do to get to a debt-free country. Karibu sana, Rama.
Thanks, Winnie. I don't think I'm going to use all 15 minutes. I'll try and keep it relatively compact. But my thinking around this is centered on three main issues. So purely as a math issue, we'd ideally have to be running consistent primary surpluses for a fairly long period of time. And the way we used to think about this, I think when I first got into business journalism, was we'd sort of try and keep whatever our public sector spending was below whatever our tax revenue was. This is a sort of rough shorthand of it. And Jubilee 1 and Jubilee 2 pretty much blew that right out of the water. And over that period of time, we started seeing, just looking at the charts that Derry put over, if you essentially overlay this public spending on top of that, what you'll essentially see is that we've just been spending money like drunken sailors for a very, very long period of time. The bigger question, though, is it actually possible to pull that off? And when this invite came out, I ended up looking for some examples around the world of countries that have managed to stay the course, right, and trying to essentially run a fairly tight fiscal ship. In past conversations with Nderi, I know he's cited examples of the Americans running budget surpluses, for example, I believe it was in the Clinton years. A more recent example would be Jamaica, right? They've managed to run budget surpluses, and they had a proper debt crisis. The debt GDP ratio, I think, was close to 150% of GDP. They've managed to bring that down to under 100% of GDP. So the delta there is a fairly significant one, and it's broadly moving in the right direction. And this happened under governments from opposing parties over a long period of time. So it is possible to essentially have public sector, or rather the public sector, to run fiscal surpluses. The only challenge we have, especially in our case, is if you look at what our politicians tend to do and the way they think about specific things, solving the big problems of the day, more often than not, they're looking at it in terms of spend. If you look at the entire manifesto for ODM, for example, and even UDA, or rather the Kenya Kwanza Alliance and the Azimio guys in 2022, all those manifestos are literally just about, we're going to spend money on this, we're going to spend money on that, we're going to spend money on this. It's going to be higher spending on education, higher spending on roads, etc. And at no point did any of them ever sit back and address the fundamental question, which Nderi and Stella Sokebe have alluded to. Where's the money going to come from? Right? Because at the root of all our problems, or rather a big chunk of our problems, is a massive lack of income. Now, in the Kenyan context, just using our data here, effectively we have to do one of two things. Well, strictly speaking, I think we'd have to do both. Either our taxes have to go up, or rather our tax revenue collection has to go over 4 trillion shillings every single year, which is going to be fairly difficult to work our way towards in the immediate short term. Alternatively, we're going to have to make some drastic cuts to government spending, which is what Stella was talking about a little earlier. And pulling that off politically is going to be very, very challenging. But at the end of the day, I think the more interesting way of framing it would be to say, look, one way of looking at this is either we impose that fiscal discipline ourselves before we get to a point where the market imposes it on us, right? Because the way I look at it, when I see T-bills at 15%, at 16%, at 17%, my concern with that is that the market is simply saying, I have no trust in politicians to be able to actually park my capital in systems that they control for a long period of time. So that's the first idea. Primary surpluses, we're going to have to figure out a way of running those. And Jamaica offers an interesting example of what might be possible. The second point is this: tax policy also has to be extremely pro-growth. And there's some ideas that we have discussed in the past. Kwame Wino, for example, was on a space that I hosted on the 10th of July. What was I saying? Some of the things we discussed at that point in time in that particular space was tax policy as we have at the moment simply isn't working. The protests, the anger that we see on the streets, the despair that we see when we open our phones, and we've got individuals who are saying, look, I've got this medical bill I need help with. My child is going to university, I need help with fees. We all know someone, I think, in our social circles who has been in the job market for a relatively long period of time, and they're struggling to find something. And that's not accidental, because if you look at what's the job creation in the formal sector, especially in the private side of the chart, it's been pretty abysmal. Last year, we only created, 45,100 jobs? And this is an economy that used to reliably create at least 125,000, 100,000 new openings every single year, right? So that delta, that decline in the amount of new openings that we're creating, that tells you something, because a lot of the new jobs, quote unquote, that are coming through, more or less are in the informal sector. And then there's a question of credibility around public statistics that has been fairly alluded to most of the time. One of the more recent examples I can give you is, and this again from IA staff, I believe it was Fiona Kadia who pointed out that our inflation data, food inflation data, has been revised, quietly revised, over the last 2-3 years, and yet somehow the top line number hasn't really changed much, despite the fact that food accounts for what, like I think a third of our inflation print, right, or rather the CPI basket. Now, if we're doing that on food, on other things, I think it would be a reasonable supposition for anyone to ask if our stats on food inflation are not essentially that accurate. What else are we missing, right? So that's all these things, sort of come together. Tax policy has to be extremely pro-growth, because in part, to put it bluntly, we need to starve this leviathan that is a Kenyan government. A lot of the cash that has been taken out of our pockets is being blatantly misused. 1 minute you're told, well, oh no, we need to fix the housing problem by increasing supply. And to do that, we need to take money out of your pocket. Okay. And then you take that cash out of people's pockets, and then it's literally just being recycled, most of it anyway, into treasury bills. So effectively, the state is now competing with you for investment opportunities in the market, if you can even call those investment opportunities. And then the government turns around and says, well, now that we have all this capital lying here, see, we just use it to build markets or to build something else, right? That mission creep is a problem. And personally, I'm not in the business of trusting politicians to do the right thing. The sensible thing there to do is to literally starve them of the resources that essentially they're misusing and stealing in the first place. So in case you want to get a deeper dive onto some of the ideas that we discussed, I'm going to put a link to the space that we discussed, that we had rather on the 10th of July, which will have some very interesting ideas there on tax cuts, pretty much right across the board, because ideally, we have an income problem, and I don't think we're going to fix it by keeping, by continuing our current policy course, which is essentially giving more cash into the hands of a government that is generally just wasting enormous amounts of it. And there's all sorts of examples we can use for that. If we've discussed about the way, or rather, Stella pointed out, all the issues that we have around IFBs and the Eurobonds that we issued. We say we're issuing an infrastructure bond, but if you look at the prospectus, there's no specific project, right? That they say, if you give us this 20-something billion that we want to raise, we're going to invest it in this road, or we're going to invest it in water or healthcare, or we're going to put it into, even bluntly, the Talanta Stadium thing that was being launched by the president more recently. And to add one more example of the sheer waste that we have across the board in government, think about Kenya Railways as an operating entity. We know what their revenue side looks like because the revenue numbers from meter gauge rail line operations and SG operations, that side, that data, they do make public. And even if you add up all the revenue numbers there from passenger traffic and cargo traffic, their revenues per year don't really go much past 15, if we're generous, 16 billion shillings. So if they're posting a loss of 50 billion shillings, which is essentially the number that they put up last year, that tells you that there's supposedly an operational cost there, which is keeping that company afloat to at least 65 billion last year. And that raises a million and one questions. Like, what is it that this company is doing that is costing them the better part of 65 billion Kenyan shillings? And debt service is part of it, but it's not the whole story, right? Which loops back to the lack of transparency problem that Stella was talking about a little earlier. The third, and I think the more difficult question, is how do we model political behavior, both the behavior of politicians, but also the behavior of us as voters around these issues? And I don't have any straightforward answers to that, but I can see that our current path is unsustainable. So, for example, when David Maraga announced that he was running, he wants to be the next president of the Republic, and the reactions to that for me were quite interesting because the individuals who literally were like, especially when he said that he's fundraising, he's publicly fundraising in order to essentially fund his campaign, the reaction in some quarters was one of disdain. It was like, dude, you can't be raising small cash in order to run a political campaign. You need money, right? And that leads us down this path of really skewed incentives, because if you need money to be seen, quote unquote, as a credible political actor, where's that money going to come from? It's going to be stolen from you, as a taxpayer, right? And we see that with the rise of this tenderpreneur classes, especially in Jubilee 1, Jubilee 2, and it's not new. It's happened before, even with the Kibaki administration, the coalition government that we had post 2008. That in and of itself is not new. What is new, however, is that it's been literally supercharged in the last 10, 15 years. And cracking this idea that you need to have stupid amounts of money in order to be seen as a credible politician, that is going to be the biggest hurdle, I think, to getting the public to essentially understand that, look, where we're going now, we're driving off a fiscal cliff, and we need to drive off that. But for that to happen, we need to make some very hard fiscal choices. To use our local parlance here, we need to call ourselves for a small meeting behind the tent and have some very hard discussions around what we're going to be spending money on or not spending cash on. So for me, those are the three things that need to happen. We need to be consistently running primary surpluses. Tax policy needs to be aggressively pro-growth. And third, and most importantly, we really have to change incentives around the way our political class behaves. Winnie, back to you.
Yes, thank you so much, Farmer, for giving us your views and very elaborately taking us through what, in your perspective, should be done to get Kenya in the right direction, which we are speaking to today, which is debt sustainability, and later or in the foreseeable future being debt-free. And remember, we had mentioned earlier, for purposes of today's conversation, debt-free, we're referring to, how sustainable can we as a country get our debt to be, to avoid the burden to future generations, and just for us to have some fiscal sustainability and fiscal sustainability predictability that could actually lure in all these things that we have said, investor approval and much more. So I like the conversation going towards these development projects that we have been having and the return on investment that we are yet to see for most of them. And I take you back, I mentioned earlier, conversations on the white elephant that the IEA has done. And if you go back to those conversations, you realize that, well, a lot of these development loans that we take, we actually do not get the return on investments on them as we should. And what we do is we continue borrowing without evaluating the impact or the effect of what we had borrowed previously and the projects that we use the borrowed money for. So that again drives our debt burden. We are not asking the big questions. And Stella is saying we need to ask ourselves, we need to hold ourselves to account on these monies that we are borrowing. If we went back and we asked ourselves, fine guys, we borrowed we borrowed Eurobond. What can we say as a country we actually achieved out of the borrowed money from the Eurobond and all these other monies that we have borrowed from the IMF? And if we even go back to the conversation on the IMF, and a lot of the debt conversation is normally targeted at IMF, or the amount you're borrowing from IMF is a lot. If we look at the debt stock and the debt, the itemized debt, you realize that the loan that we've borrowed from IMF is actually less than 1% of the total debt. It's about 0.76 thereabout. So those are the questions that we should be asking ourselves, and our speakers are actually pushing us in that direction to ask this very difficult yet very important question. So we will now proceed to plenary, where you, our participants and our listeners have an opportunity to ask the presenters a question based off what they have shared with us. We began from the picture of our debt stock, what Kenya's debt status looks like, and then our speakers have spoken to what it would actually take us to get to debt sustainability and possibly being debt-free. So you will have the chance to unmute yourself and ask yourself a question. But as we wait for you to raise your hand and ask your questions, there's already a question on the chat box for Eva, from Eva to Stella, and she's saying, on the public-private partnerships, doesn't scaling up on them lead to rentier economy? So how will we navigate that? If that happens, then how do we navigate that? So Stella, you'll have that question to respond to. And then I can see Emmanuel has a question and his hand is raised. So Emmanuel, please unmute yourself and ask your question to the speakers.
Okay, thank you. Thanks, Winnie. So Winnie and team, this was a very good presentation. Now, my first question, there was something that Rama Yang said about campaign funding. So my question is this: do you think that so far, and especially in this moment when Kenyans are have shown some interest in the intricacies of policy, that we just haven't seen someone come out and lay out the problem that the country is facing in terms of debt, some of its implications, and then propose a solution, even when that solution needs the help of the electorate in the form of public participation, so that that candidate can just put themselves forward on purely on rhetoric, whatever whatever the size of their campaign war chest. So that, and do you think that if this could happen, that even the question of campaign funding as a metric to measure the merit of a candidate could actually just be maybe overcome? Thank you.
All right, thank you so much, Manny, for your question. So I will start with Stella. Stella, kindly unmute yourself and respond to Eve, and then Rama will respond to Emmanuel, and then we will go to the second set of questions. Proceed.
Thank you very much, Winnie and Eve, for the question. She asked whether PPPs would encourage rentier economies, but I think on the contrary, it would help move away from such an economy, because number one, when you have more PPPs, then it means we are reducing the burden on the exchequer or the burden from the citizenry in terms of paying taxes for very huge projects. Or, for example, the situation that we are in right now, where we have 60% of our revenues going into debt servicing and leaving only 40% for recurrent expenditure, development, and also county equitable share. So I think it wouldn't actually lead to a rentier economy, because in my understanding, a rentier economy means an economy that largely depends on one source of revenue, and that is mostly external in terms of aid and other sources, in terms maybe grants and all of that. So PPPs would, and it doesn't mean necessarily PPPs should come from external parties. We could have PPPs internally and actually raise money from, for example, what we are seeing right now, even though it involves an external party, things like pension funds, because when you look at the assets under management in our pension industry, it's in the trillions. So this is money that we could actually be creative as a country and have some of this money directed in more on what we have internally or domestically, ramp that up so that we have more infrastructure and more money remaining in Kenya, as opposed to having PPPs that are more external alienated, where we have money going out. That would be my feedback. Thank you very much, Winnie.
Thank you so much, Stella. Rama, your response to Emmanuel?
So one of the interesting things that has that often happens, at least in our public discourse, is that when politicians are out of office, they have what we sometimes like to refer to as there being suddenly very clever syndrome. So, for instance, Ndindi Nyoro, for a very long time, was the chair of the Budget and Appropriations Committee, and now that he's effectively on that out, is no longer in favor of State House at the moment. Now, all of a sudden, he's become very critical of the same projects and the same sort of big government, big spending ideas that he endorsed and effectively shepherded through the House when he was Budget and Appropriations Committee chair. Now, other individuals who potentially could change how we think around public finance and campaign finance as well, I think the groundwork for that has been laid. So the example I would give you is look at how public finances, or rather how individuals, how Kenyans contributed cash, and how that was managed to cover the medical bills of individuals who were injured or hurt or killed, and the medical bills that arose from that last year during the protests. And granted, Hanifa ran into a lot of public opprobrium. There was a lot of personal attacks against her, but to her credit, she was transparent about how that money was raised and where it was used, how the cash was paid out. So from purely a civic perspective, right, if you just leave politicians out of the picture, I think we are on course to laying the groundwork for developing that sort of culture amongst ourselves. From a political point of view, though, I haven't seen anyone yet among the characters who are planning to run for election in 2027 who are willing to confront that Leviathan head on and to actually campaign on saying, listen, we're going to have to cut the size of government. It's an unpopular position, especially if you're dealing with the civil service, because obviously from an incentives perspective, if your next boss is campaigning on the basis of saying you might lose your job, you might not exactly be the most popular character in the room. And for anyone who runs on that platform to make things work, I mean, it will be a hard sell, but you'd essentially have to, I guess, the way I would frame it if I was in their position would be say, look, as a taxpayer, this is how I want to save you money. And I'm going to save you money by doing X, Y, Z. We're going to downsize the size of government. We're going to deal with a lot of these, we're going to end rather a lot of these public spending programs that are not fiscally sustainable. And some of that will be looking at things like, looking at the sort of contract that Kenya Railways has gotten itself into, and the fact that we are inevitably providing subsidies to that particular company. It would mean things like ending these implicit fuel subsidies, so-called fuel stabilization, that we have very little transparency on. One of the things that, and I'm doing this from memory, so don't hold me to account to it 100%. But one of the structural benchmarks that we had to meet under the IMF program was that the Kenyan government, and especially the Energy Ministry and EPRA, had to provide a detailed justification saying, if we intervene in the fuel market, these are the triggers that essentially would lead us to try and intervene. This is why we will stabilize. This is why we will not stabilize, and so on and so forth. And we did not ever make those justifications public, which raises a whole bunch of questions, right? So going back to the original point that I made, someone has to starve that Leviathan. And I think it would be a relatively straightforward argument to make to the Kenyan public. Then there will be other things like the housing levy. If you make an argument that, look, we're just going to give your money back to you by removing this so-called affordable housing levy, which is clearly not being properly utilized. And in any case, those are things that is a problem that the market can much, much better solve, especially if government focuses on what it should be doing, which is policy making. And even on the healthcare side, SHA has run into the exact same problem that NHIF had, even though the Kenyan government consistently persists with this ridiculous lie that, oh my God, we've registered 20-something million people on it. But if you actually do a deep dive on NHIF's numbers and you actually look at their register, at some point, I think they peaked at like 16 million people registered on their books. But out of those 16 odd million, if you actually ask, well, how many were actually consistently paying into the fund? It was a relatively small amount, probably like 4-5 million people at best, right? The income problem has not changed. It is still there, right? So the problems that NHIF faced in terms of solvency are the exact same ones that SHA is going to run into either way, right? So if you build an argument around telling the Kenyan taxpayer, look, I'm going to give you your money back. I'm going to be a prudent steward of your cash resources. And there will be pain, it will hurt. But in the long run, this is going to be your benefit. I think someone could build a credible argument around it. Do we have any politicians who are doing that right now? In my view, no.
Thank you so much, Rama, for responding to Emmanuel. So Wycliffe is saying, so the speakers have, and what needs to be done or what needs to be shelved. And then Honor says, so Rama, we have highly qualified experts advising the president in parliament and also at the Treasury and Central Bank, listening to these ideas, to these positive ideas. I think our problem is bad politics driven solely by individual and not public interests. Well, Honor, it's your view, but in the recent past, we've listened to some of the things the president is saying, advised by these so-called qualified experts. And trust me, some of them can make you just want to run. And at this point, you say, Dunia isimame ushuke, because you can't believe some of the things they say. So if that's what you're calling qualified experts, that would be a bit, it's debatable. Yeah, and then Jeremy is saying, is there a possibility to entrench the enactment of a debt register in law, the way we can have full visibility of what we borrow? So we could have responses from our speakers. So I will start with Johnson. Johnson, please give us your views on these comments, and then we'll proceed to Stella and then to Rama. Thank you.
Can you repeat the question? I got lost in my thoughts.
Okay, so the speakers, Wycliffe is saying the ideas are you're giving very positive ideas on how to cut spending on the government's end. But now, can you also propose public participation engagement ideas so that these ideas can be presented as a proposal of project evaluation and what needs to be done and what needs to be shelved? I don't know if that's clear.
Yes, that is clear.
Okay.
Sorry, let me put on my camera. I wouldn't even be proposing. In fact, my idea is government should be scaling back projects. I think the idea that the government projects is what drive economies has been tested and largely found wanting. The reason we're in this economic problem is specifically because of that. Now, what I would do though is, and maybe I should, is run a constitutional amendment proposal to either fix the tax rates, or even put in a balanced budget amendment where we're saying the limiting should be with where how much government will tax. How much government can spend at any one time, or even maybe we should take away the power of parliament to tax and make that a plebiscite issue. So anytime taxes need to go up, government needs to hold a referendum. I think those three ideas are the ones I've been playing with. Maybe I should convert them into constitutional amendment bills and put them out there.
Thanks, Johnson. Stella?
Thank you very much, Winnie. So on Cliff's question, I think this is actually what is supposed to be happening, considering what we have in terms of CDF laws and all that, because I believe the representatives of Kenyans are supposed to go to the grassroots and actually discuss with citizens on what they want and what they think is more important at a given time. So whether that is done, I'm not sure, but I believe that is what should be happening. So Nderi provides a scenario which is ideal, and I think that we have a reality here where the government is not going to get away from development and projects anytime soon. So I'd suggest that we do more of the value assessment and actually see what should be the priority when we are doing projects or when we are proposing projects. Number two, on what Jeremy asked, whether there is a possibility of entrenching the enactment of a debt register in law, and that way we can have full visibility of what we borrow. I think, again, we have a lot of visibility of what we borrow under the Treasury website. There's a lot of data on the external debt register. We have the medium-term debt strategy. We have all of these, but my recommendation in this case would be on more transparency on the terms under which we borrow. Because when you look at the borrowing that we have, and especially external, we do not get to see the terms in terms of whether the debt is amortized, whether what interest rate we are paying at, what conditions are attached. This is only possible for the Eurobonds because we have the prospectus. And when we had the IMF program, which comes with conditions, so for them, we actually would get more information from the reports that IMF gave as opposed to what our government gave us. So for me, that would be a recommendation that we get more information on the terms and conditions under which we borrow our debt at, and that way we can be better active citizens and experts or professionals in terms of giving our ideas and proposals, and also telling or saying what we feel is not acceptable or will lead our country into more unsustainable debt levels. But as for the visibility of what we borrow, I believe that is well captured under the Treasury website. You could get so much information in terms of debt. And even when we have the supplementary budgets or budget documents, there's mostly a lot of information towards the end of the pages in terms of what the government is expecting to borrow, what we achieved the previous year. So I think that information is there. Thank you, Winnie, and back to you.
Rama?
Okay, so I want to start with Jeremy's. Sorry, I want to start with Jeremy's question with respect to the question around visibility. So two things, building on what Stella has said. Part of the problem is that the way our information is, or rather the information that Treasury produces is, it's not 100%, it's not complete. So I'll give you an example. If you think about the way the quarterly economic and budget reports are put out, or even the budget, sorry, the debt, the public debt register is updated, more often than not, it's, you really have to go digging in to find the terms, right, under which a specific loan has been issued. And ideally, that should not be the case. In a sensible situation, the state is obliged to tell you, I went out there, I went to Trade and Development Bank, and I took a syndicated loan of $800 million, $1 billion, whatever the number is. These are the terms on the loan. This is the interest rate on that loan. To date, if you actually look at the data that the Treasury puts out, they very rarely ever put out any information explicitly saying, this is the interest rate on the TDB loan, and these are the terms and conditions attached to it. If you know where to look, you can go and find the debt contracts that we have with the World Bank. They don't hide theirs. It's not actually that complicated to find them. We can actually get them on their website. But for a lot of the other bilaterals that we have, there's virtually nothing in public. Treasury was sued multiple times, actually, by civil society organizations demanding full disclosure of all of the debt, or rather the debt contracts that were taken on with the Exim Bank of China. And the defense that the Kenyan Finance Ministry and the Transport Ministry came with to court, even after they lost, was we can't release this information on national security grounds. There is no national security implication with respect to a railway line, but our employees are running around saying, oh, no, we can't tell you all the details on why we borrow this money and on what terms, because of national security, right? Which sort of loops back to the question around expertise and competence that Ona Otieno put out there. The law at the moment actually does provide for a significant amount of transparency. The problem is that our politicians simply are not held to account for these things. If you think about the 2016 Access to Information Act, by and large, there are places where it literally says, there are things that a public entity has to provide, right, to taxpayers. And then on top of that, even in specific statutes, if you think about Kenya Railways, and sorry, I'm going to go on and on about because they're my pet peeve at the moment. If you think about Kenya Railways, and we can actually do this as an exercise at the moment. If you go to either their website or you go to Parliament's website and you actually look for their annual reports, I guarantee you that the most recent one you're going to find is very likely from either 2020 or 2021. Anything after that, you're not going to find. And please note, the Kenya Railways Act is very clear, and this is section 27. The board shall, within 9 months after the end of each fiscal year, prepare reports on the operations of the corporation that year, and shall transmit that to the minister, who shall cause the same to be presented to Parliament, together with the statement of accounts and the report of the Auditor General. Now, by law, they're obliged to make this information public. They have not. So it's not really a structural question, in my view. It's more of a question of the law's already in the books. There's an obligation for transparency, but our politicians have simply chosen not to follow it. How do we compel them to do that? We're going to have to get very targeted and very strategic with litigation, in my view, because even just, to use the SGR Exim Bank of China contracts as an example, getting to a point where the government lost, because the High Court actually told them, you have to make this information public. They refused. To date, they've still not complied. Getting to that point took multiple years. And that is one example of just how entrenched this attitude of, no, we're not going to give information, all the information, we're going to make all of it public. That is something we'll have to deal with, and strategic lawsuits around that, I think, will have to be executed. The things, sorry, if I can just respond to what Derry said, the things we agree on, I think, with respect to having a balanced budget amendment, I probably wouldn't go as far as turning taxes into, or rather having to raise taxes into a plebiscite issue, in part because of sort of flexibility problems that brings along with it if you're trying to run an entity as massive as a government. It might end up tying you up if you need to rapidly respond to an emerging crisis. But I would be in support of a balanced budget amendment. Just say, like, you can't blow past 4% or 3% on the fiscal deficit over X period of time. And if you do, you have to, make compensatory moves in terms of cutting spending in order to get that deficit back down. Because, to go back to the original point that I made, if we're going to aggressively tackle that debt burden, we've got to be serious about and very intentional about, running primary surpluses, and relatively large ones, for a long period of time.
All right, thank you so much, Rama. And a lot of times when people are speaking about transparency with information, especially from government, we tend to think it's cliche, but at the Institute, we can tell you it's no longer a cliche, because just taking us back to even those contracts, my colleagues conducted an analysis on the Public Procurement Risk Index, and one of the challenges they will confidently tell you is the number of contracts that are missing from that portal, that a contractor knows very well that once they've received, I should actually post that contract. So tracing the performance of that contract is actually an issue because it's not on the portal that it should be. So yeah, that the transparency with information is something that should actually be looked into. So my colleague Kwame has a question. I'll allow him to ask it. And as we get his question, there's a question as well from Eva. There was a suggestion to scrutinize pending bills and other loans, such as hustler funds. What will be the impact on our debt if this gets to be implemented? Kwame, please proceed to ask your question.
Right. Okay. Thanks. I'm Kwame Wino from the Institute of Economic Affairs. I'm truly grateful to three panelists, Stella, Johnson, and Rama. For one reason, speaking for the IE, I think we've had a conversation on public taxation, which is focused on solutions, but you all gave us a fantastic view about what the diagnosis, what is the problem before we think about solutions, which is excellent. I'm grateful on behalf of the IEA for both, I mean, for the three of you for giving us those, because what most of the conversations, including the business media that we hear, terrible cliches, we make it look like Kenya's debt problem is entirely about quantum. But you've all shown fast interest and explosion, and obviously revenues, I mean, debt servicing growing faster than revenues. So that's at that level, it's actually a structural problem. Then on the other side, of the supply side, government is not clear with, or rather does not face incentives to procure debt efficiently and with proper disclosures, and of course the politics around that. So that's fast. Thanks again for making this clear. Now, I think what all of you have made it clear is that anybody who's looking at debt, and especially any professional who pays their taxes to the government of Kenya, does not necessarily earn from it, but pays their taxes to the government of Kenya, should be very concerned. And you all have given us the idea that there's definitely, starting with Stella, Rama, and of course Johnson as well, that some kind of reckoning is necessary. I think you've also made it clear that the possibility that you're going to have to, I mean, that revenues will raise far above growth rates and debt is unlikely in the time frame that we were speaking about here. So something really serious is going to happen. It's going to have to happen, because yes, growth is not happening too fast. I mean, as fast as we'd like to, or as is possible given everything that we have. I have a suggestion here. Rama, you mentioned specifically Jamaica, and Jamaica did a lot of fiscal consolidation, which was mostly trying to get a primary balance. And it actually did a lot by shrinking debt from all but, I mean, close to, I think 150%, upward of 150% of GDP, and has brought it down now to more than half of that in proportionate terms. The problem with Jamaica's outcomes is it did a fantastic job, nobody gives it credit for, but it's hardly had growth, anemic growth, so that in the 30 years, Jamaica's average annual growth in income per person is like less than 1%. Kenya's territory, basically, in the same period. So it's telling us that that needs to be done and a little bit more. And that's where now I'd like to get an opinion from all of you. Look, you're saying that Kenya's debt is unsustainable and it's going to remain unsustainable for a long time, possibly even for like a generation. I'd like you each to respond to the fact that what if we speak about the big R, or let me say this, a cutoff. Is a cutoff something, debt write-off something that you think could be part of the solution? And the reason I mentioned that is that it's not just about reducing Kenya's debt to sustainable levels. It's ensuring that that change leads to a growth impetus. Because growth, I mean, debt can actually be sustained at low levels or at acceptable levels without growth occurring. So all I'm asking myself is, do you think in order to get the combination of sustainable debt and the fast growth that actually Kenya needs, which in my view should be upwards of 7%, a write-off is necessary? Just your thoughts on that, Winnie. Thanks. And Winnie, I think you read Eve's question wrong. She was asking about securitizing pending bills. So maybe you're, our guest, I mean, our panelists should know, yeah, not scrutinizing, but basically securitizing. Yeah. Thanks.
Sorry
Thank
about
you,
that. Thanks for the correction, Kwame. So yes, Eva is asking about securitizing pending bills and not scrutinizing the pending bills. So our panelists kindly have a go at responding to Kwame and Eva. I'll start with Rama this time. Rama?
I think there's a case to be made for, I'm not sure if we can get a full write-off, but I think there's a case to be made for restructuring some of our debt. There's parts of it that just look needlessly expensive, crazily expensive, and there's a very distinct lack of transparency around it. The Exim Bank of China is certainly one, because the fact that the Kenyan government has expended so much time and effort trying to hide all of the documentation around that, and then on top of that, the fact that Kenya Railways is already costing us a ton of money. Their annual loss the last fiscal year was around 50 billion. The year before that was somewhere in the region of 33 billion shillings. I mean, it's simply not sustainable to have a company here that's costing us the better part of 100 billion, maybe more, just in direct losses. And then if you factor in debt service, it's a lot more. So if I was going to start along those lines, I'd probably target restructuring Exim Bank of China debt, TDB debt, because TDB alone, I believe this fiscal year, we're paying them something in the region of almost $1 billion combined, in terms of both principal and interest. Now, TDB and Afrexim Bank have both had their issues. They're very reluctant to take any haircuts on the debt that they have issued, and they believe that they have sort of super seniority status akin to the IMF and the World Bank. We're seeing that at the moment playing out with the arguments they're having with the authorities in Ghana and Zambia. Whether or not that will actually be sustained, I have questions around that. Because if your members, if your shareholders are having fiscal problems, and on top of that, you're lending to them at extraordinarily expensive rates, at some point the crisis is going to come in, and then what do? You're going to have to restructure one way or another. Securitization of pending bills, I'm not 100% sure if it would effectively work in our system, because in part we'd have to go back to the question around, or rather the point that Stella raised a little earlier. If we're in an environment where we know that individuals tend to inflate procurement contracts dramatically, they dramatically inflate procurement contracts. A pen like this that ideally should be costing something like I don't know, 20 shillings is now being charged to the taxpayer at 100, effectively 5x. Wouldn't we essentially be paying for and therefore incentivizing that sort of bad behavior in future? So the question therefore would be, how do we prevent that moral hazard problem from ballooning into something much, much larger? I'd have to give that a bit more thought, but for the time being, I would not be in favor of securitization rather around pending bills. With respect to the Hustler Fund, that falls back into that category of things that government has absolutely no business doing, in my view. This attitude that we often see so pervasive, especially in government, that, to use Johnson Berry's phrase, Kanuni Baba na Mama, government is going to provide this leviathan that covers everyone. The reality is it can't, right? And these are things that the private sector is doing a hell of a lot better, and their incentives are aligned to essentially provide a much more effective way of distributing capital and recovering that capital, because it's their money at stake. When it's taxpayer cash that they're essentially funding your operations, which is basically what's happening with the Hustler Fund, with all their issues, I would be very, very reluctant to continue with that idea. If I was in government today, it would be one of the programs I would cut from day one.
Johnson?
Thank you, Winnie. Thank you, Kwame, for that question. Very interesting question. It's something that I've toyed about my mind, and I'm making reference to the idea of haircuts, or because I think in my view, Kenya should default. In my view, the only question is how. Right now, like I said, I observed earlier, I think we are doing some strategic defaults. We're not paying suppliers on time. We're not, some of the sorry for the knocking, there's some construction going on where I am. The government is not paying the parastatal debt on time. So that's going on. But before I will propose to take more extreme measures on debt restructuring, I would try as much as possible to sort out. To release to lighten the balance sheet, as it were. Like I said, I would only consider more extreme measures of default if it was after privatization and I was unable to raise additional funds. So I do think we can do 100-200 billion in revenues from privatization. I mean, from sale of shares in commercial assets of the government. So I think that could be an area of raising funds, and I think it would still have the effect of boosting our economic outlook, because then I believe in sectors where government pulls back, you are likely going to see an explosion, like what we did see in energy sector. When government pulled back, there was an explosion of investment in that sector. We saw the same in telecom. So if we can see this, if we can do that in seaports, airports, additional rollback in energy as well, I think we would see an explosion of investment in those areas, and probably that will help also boost government revenues. As to whether that in itself will bring back the government to a sustainable position, I don't know. But that I would do that first before I take more extreme measures. Securitization of pending bills. When I was speaking about strategic defaults, I did mention, the fact that government is not paying pending bills is one of the reasons why government's finances are still stable. Had it been mandated or obliged to be paying these bills, I think we would have defaulted much. We would have been much closer to default, if not already defaulted. So I don't know if securitization of pending bills will actually help. I know it has an impact on bank balance sheets, because banks have lent to guys who have been unable to pay back. And I know it's a significant problem in the economy, but the resolution for that, I think, would be to figure out how to lower government spending rather than give it additional money, because that will just be feeding a bad habit, as it were. Was there another question?
No, that was it. So we'll hear from Stella.
Okay.
Thank you very much, Winnie and Kwame. So I will start with the question of writing off debt. And I'm assuming writing off debt is defaulting. So I will agree more with Rama as opposed to Johnson in terms of defaulting. I wouldn't support a default, and mainly because of the factors that trickle down from that. And especially if you default on a commercial loan or a loan that involves, let me say, retailers, because when you look at, or individuals, when you look at loans like Eurobonds, when you default on such a loan, the noise that would come with it is something of what we saw before we cleared the 2024 Eurobond, and not entirely clear because we borrowed to repay. Let me just say, before we sorted it out, we had a lot of issues with our currency, with capital outflows, even in the capital markets, including the equities market. Our stock prices had plunged to very low levels. And also, when you look at examples of countries that have defaulted on their loans, you get to see, in my view, very dire effects in terms of the cost of living that is left in those countries. And number two, even the cost of borrowing, because at the end of the day, if we do a write-off a loan and not look at the expenditure side, we will still need to borrow. So if you're still borrowing, then it means we will be borrowing at very high costs. And I do not see the balance out of that. We are moving from one problem and just getting ourselves into another problem. So in that case, I would agree with Rama in terms of restructuring our loans, and mostly on the interest component as opposed to the time component, because if we only restructure on the time, then it means we even pay for longer and maybe pay more of the interest. So if we could restructure on the interest component, I think that would be a better factor or a better move in terms of the commercial loans, because for concessional loans, then those ones are a bit lenient in terms of the interest that is charged on us. The other question was on, or let me first comment on another bit that Johnson commented on in terms of privatization. And I think I agree with him on that particular aspect, because we are financing parastatals that are of no value in my view. When you look at both sides, there is no particular value that we get, or the value is not justifiable by what is spent. So I don't see why a whole country would be paying taxes to benefit a few people because they're employed there on boards or whatever contracts they have, but then the value that we get from it is not justifiable. Same case with recurrent expenditure, which is, again, is the number two of what we spend most on. So remember the argument that we always have on, we only have 1 million people that are employed as civil servants. So when you look at the maths for a country that has 50 million people, as much as there's a trickle down effect in terms of these people are paid and then we have money circulating into the economy, but at the end of the day, what does this translate to? Do we have efficient services? When you go to a government office, do you get services that are commensurate with what we pay for these services? Because when we are concentrating a huge chunk of our money or expenditure to a portion, a very small portion, which is less than, I think, 1% of the population, then we need to see so much value from it. I don't want to go to an office, a government office, and I'm spoken to rudely because I'm there and they're on the other side. So it doesn't make sense for me, and I will continue to insist on the value for money. So whether we put money in education, whether we put money in the health sector, we ought to see the value for this money at the end of the day. And then on the issue of securitization of pending bills, personally, I think it's a good idea. But then I am convinced, and I tend to believe that securitization is still debt. So this is still pushing debt, because if, for example, let me use the example of the road maintenance levy, where 7 shillings is going to, has been securitized to pay pending bills for construction of roads, for example, then this means we are foregoing 7 shillings out of the 25 shillings that we are paying as levies, and this is revenue for the government. We are foregoing it and paying money that we spent a long time ago, let's say 5 years ago. So for me, I see it as debt still, and I don't understand why we do not add pending bills into debt that we have, because this would give us a better perspective on the amount of debt we owe to people, to institutions, and to individuals. So that would be my view, but it is a short-term fix for the problem that we have. But at the end of the day, it adds on to our debt and reduces the revenue and levies that we would have collected from these particular sectors. Thank you very much.
All right, thank you so much, Stella. We seem to have gone over and beyond the time we had allocated for this. It has been a very interesting conversation. And as we come to a close, I would like to give our speakers an opportunity to give their closing remarks as we close. And for Stella, as you give your closing remarks, my colleague is seeking clarity. So that when you mentioned the changing interest component, he says the changing interest component is still book impairment. which involves restructuring and default? Or did you mean debt reprofiling? So as you give your closing remarks, Stella, you could please respond to Leo, and I'll start with you, your response to Leo and your closing remarks. Karibu, Stella.
Thank you very much. So yes, let me just say I would summarize it to debt reprofiling or profiling, because again, if we are to reduce interest, for example, we were paying for a particular loan at 10% and we now want to do it at 5%, then it means we are defaulting on half of the interest. So yeah, thank you for that. And as for my final remarks, I am grateful that we had this discussion, as this is a major concern for our country. And I believe that money matters, or the fiscal space in our country, is mainly the source of a majority of our problems as a country, because it's money that leads to personal interests in our politicians. It's money that leads to public outcry, and it's actually money that have led us to the public protests that have been economic-led for the past 2 years in our country. So it was a valid conversation and a timely one, and I hope it continues as we continue to charter ways of having sustainable debt levels in our country. So thank you very much, and thank you very much again for having me. Bye.
Thank you, Stella, for your closing remarks and for responding to Leo. Johnson, your closing remarks.
First of all, I'd like to thank IEA, yourself, Kwame, and team for this discussion. I think it's important discussion. I'd like to say in the final analysis, our debt problem is really a behavioral problem. I remember one leader of a country, I can't remember which, who said there's no such thing as left and right. There's only bad and good economics. So we need to go back to good economics. If Kenya is to get back to a sustainable economic growth path, and we must start asking ourselves hard questions, especially about our behavior, because that's where everything starts. In the Swahili say, ukiona vyaelea jua vimeundwa. If you see we have behavior as is, no, it's largely because it's being driven by, I would even argue, from the grassroots. So I think change of behavior is necessary. Expectations of government, must ask ourselves what should we expect about government, from our government, and what is the role of government from the and we need to ask ourselves what the role of government is, and we need to start asking ourselves these issues, philosophically, from basics, if we are to get back to the straight and narrow. Thank you.
Thank you, Johnson. Rama, your closing remarks.
Indeed, apologies everyone, I logged out briefly there for reasons not of my own making. But I'll summarize with a 4-letter word: pain. There's going to be pain either way, right? The only question that we have to answer, I think, as a society, is this pain that we can take of our own choosing? So essentially, the pain of making those hard decisions on how we're going to restructure public finance, restructure the architecture of government, restructure, ask ourselves questions like, okay, we ditch the Hustler Fund. Well, the private sector can step in and cover that. We ditch the SHA. Some component of that might remain, but the private sector, by and large, can do a pretty good job of providing low-cost medical insurance without adding to the fiscus. We ditch the affordable housing program and put that money back in the hands of taxpayers, but also more importantly, we actually ask ourselves, what are the real binding constraints to getting a house? A lack of income is certainly one. High cost of credit, certainly another. High cost of land. Public registries around land that really don't make a lot of sense, that are not properly run, that are not transparent, that sort of thing. the pain that we have, it would be preferable for us to choose that pain ourselves rather than what is happening now, where we're sort of just driving the Kenyan bus, so to speak, right off a fiscal cliff. And that pain is a hell of a lot worse. It's much harder to recover from, and the damage from that will last a much, much longer period of time. So the question before us really is, what pain do we want? And personally, I would prefer that we inflict that pain ourselves in a manner of our choosing, rather than having it inflicted on us by the market. Thank you.
So thank you so much, Stella, Rama, and Johnson, for your views and your perspective. And in a nutshell, that is Kenya's reality. It's something that is present, it's happening, and we can't run away from it. But now we need to move the conversation on debt from lamenting to changing the trajectory to how do we get to a level where we are saying our debts are actually sustainable. And so this conversation, we hope, is actually a beginning to a change in the debt conversation. Are we in debt? Yes. Can we get out of it? There are ways and there are things we can do to slowly move towards the sustainable debt. And a miracle could happen. We could actually be getting to a state where we are saying a generation is seeing a Kenya that is debt-free. So let's move the conversation from a lamentation to it's possible to get to sustainable levels of debt for the country. So on behalf of the IEA staff, my colleagues at the IEA, we are very grateful for you having joined this webinar, for your insights that you have shared with us through the Q&A, and even to our presenters for enlightening us and giving us their perspective for the debt conversations. And we really hope that we have given you insights that you can carry forward conversations on debt with a different view and a different perspective. And kindly remember, the IEA is a membership organization. So should you be interested to join us as members, please feel free to reach out to our communications team, Oscar and Michelle, and they'll be very glad to guide you through joining the membership. And please look out for our subsequent conversations. We still have a lot of conversations that we will be having, and we'll be more than delighted to have you continue joining those conversations. So once again, asanteni sana, and do have a beautiful afternoon.